So let's begin today with this talk in bond yields and the rollover in stocks. Joining me now, Mark Avalone is president of Potomac Wealth Advisors, and Chris Crisanti is chief equity strategist and senior portfolio manager at MAI Capital Management. Welcome to both of you. Mark, I'll start with you. What do you think bonds are telling us right now?
Bonds are telling us that when you have an environment with higher rates, if they manifest themselves, higher regulation, higher taxes, and you go back to some of the slower growth problems we had in Europe before COVID, that maybe global growth doesn't get out of control. China's certainly mired in a little bit of a quandary. So I think what's happening in the interest rate markets, they're saying, hey, slow down. This may not just spiral out of control and be an unmitigated growth spurt for several years to come, and that there are risks to economic expansion. Which
doesn't sound like you're overly concerned, but maybe we're just not. I mean, are we taking off the inflation trades, Chris?
Hi, Kelly. It's nice to be with you again. I don't think so. I think what you've seen over the last 6 months really is a Delta variant caused slowdown. So that is going to start to go away in the fourth quarter. I think you'll see it next week in the PMI numbers and the employment report. I think you're going to see an upsurge to the economy and to earnings growth in the fourth quarter, and we'll be back to higher interest rates. But I don't think that's the end of the world. I think more inflation is kind of a feature of a growing economy. So I'm okay with that.
All right. And obviously the flip side of that is strong demand, strong GDP and that kind of thing if we get there. Mark, tell me why you're sticking with big tech despite, as you say, the parroted nonsense of rising yields hurting those names. Again, maybe we don't have to worry about that thesis today anyhow.
That's right. And maybe that's one of the reasons you're seeing tech do so well today and JP Morgan lagging. But look, this discussion that if we turn into a higher rate world, that technology stocks suffer, that's 1990 stuff. That's not going to even affect the Alphabets and Microsofts and Facebooks of today's. It might impact non-earning disruptive tech, SPACs, the Teladocs, the Zooms of the world who are unproven. So I think whether rates rise or whether they don't, I don't think that's a reason to sell out of tech. We think that that's a place investors want to be. You obviously need to diversify around that. We've talked about some other ideas before about where investors can be, but technology is at the core of our investment thesis.